welcome to your Financial Legacy podcast. I am your host, Maria Ellis. On every episode, I will bring you my perspective and the perspective of my guests on financial planning and financial legacy topics. Here on the Financial Legacy podcast, we are changing lives one person at a time by creating your own financial plan and financial legacy to help you create and enjoy your financial success. Connect with us at financiallegacy.life for your complimentary consultation. Today, I'm having the pleasure of having an interesting conversation with a good friend, Michael Malley. He is the branch manager at the PRMG, which is a wonderful mortgage company located in Florida. So, Michael, welcome to the show.
Thank you so much, Maria. Appreciate it having me.
Absolutely. Tell us a little bit about your company, PRMG, and how long have you been providing mortgages?
Yeah, so PRMG is an independent direct lender. They've been around since 2001, and they're out of Corona, California. And so I've been with PRMG since 2013. I was the inaugural Fort Lauderdale branch for the company.
Wonderful. And what geographic areas does your company specialize in and why?
So we're a direct lender to the government agencies. So that would include Fannie Mae, Freddie Mac, and Ginnie Mae. So we specialize in conventional VA and FHA loans.
Good, good. Do you also do residential as well as commercial?
We are strictly a residential lender, so that's 1 to 4 units in the United States.
Okay, very good. So, do you also provide loans to international buyers? Being that you are in Florida, often there are a lot of international buyers, especially from Latin America, many of whom pay cash, but some of them like to either, put a smaller portion down or want to refinance and take out some equity. Do you also provide services to these international clients?
Currently, PRMG is not lending on the foreign national canvas right now. We were prior to COVID, and we plan on being back in that market as soon as we see some more certainty in the market in an international level.
Understood. So does that mean that the underwriting process to review and approve a transaction, is it different from domestic versus international clients?
Yes, absolutely. It has nothing to do with the government agencies that actually do those loans. It would be a totally different entity that would securitize those mortgages. So it wouldn't go through Fannie Mae or Ginnie Mae. It would have to be another company, a private investor, a portfolio bank that would go ahead and securitize those products.
Okay. So do you guys have your own capital that you invest in this lending process, or is that primarily,
Yeah, PRMG is a direct lender, so we use our own capital to fund, and we also service a portion of our portfolio.
Okay. So a certain portion of your portfolio is kept for your own books, and others are either sold out
they're sold off to the other banks and companies that want to service mortgages, so that we portfolio a lot of it and then we sell off a lot of it.
Good. So you create the velocity, right? By doing that. Okay, great. I think that's a practice, right? That most independent lenders do, and actually also large banks. They want to be able to move monies as fast as possible. Correct?
Right.
Yeah.
Yes.
Good. So as we have had previous conversations, every client has different priorities, different financial needs. Would you like to talk about how to obtain and negotiate a successful mortgage? So let's say I have a client who is a first-time home buyer. What is it that they need? How could they prepare themselves so that when they actually come and apply for a mortgage, they could have a successful underwriting and closing?
Sure. So as a first-time home buyer, you want to make sure that your credit score is at a great level, because that's going to be the cost of your mortgage is going to be correlated to your credit score. So you want to get that credit score over 700. Secondly, you want to have cash obviously on hand so that you can afford the closing costs and the down payment for a mortgage. Currently, first-time home buyers can do 3% down as a conventional loan if they have good credit over 700, or they can do an FHA loan with 3.5% down if they're under 700. Keep in mind, you would need to have closing costs to close your mortgage when you buy a home. So you'd have to calculate the amount that you need down plus the closing costs. And you can probably indicate the closing costs would be equivalent to about 2.5% of the total mortgage. Or in some cases, 2.5% of the sales price, depending on the taxes and the homeowner's insurance of the property.
Yeah, because as they do the closing, the seller will have their own costs, and then the buyer will have their own costs. What are typically included in the cost for the buyer? What are some of the items, and what are the ones that are more expensive ones, as an example?
So the most important and the most significant cost when you close a loan would be probably your title insurance, and then your Florida state tax, intangible tax, and doc stamps. Those are going to take a majority of the cost. And that's just standard no matter where you do a loan. The state of Florida gets their money for transfer for intangible and doc stamps, and your title insurance is needed when you purchase a property.
Yeah, that's very important, right?
And then your
That
homeowner's
the title
insurance.
is conveyed properly, right? That there are no clouds in the title. Tell people what would be an example of a cloud in the title.
If there was a permit that wasn't closed and that was, found on the title, or if there was an improper transfer of deed in the history of the title in the home, then there would be an issue.
And how is that remedy? Is that a long-term process, or is that something that the lender and the title company are able to coordinate and work together and to get
the title company would be
resolution?
working with the actual owner to clear up those issues, and that would be in correlation with the city.
Okay, all right. Have you had situations where that has been difficult in terms of not being able to close a transaction, or is that usually discovered much ahead of time, right?
Typically you're never going to lose many deals from a title issue that's insurmountable. So I can't recall one.
Right. And that's the purpose of having insurance on the title, right?
Yeah.
To make sure that the title is conveyed properly. Okay. Well, good. So how is PRMG different from other lenders? Could you tell me a little about it? And I'd actually also like to get your opinion about the market. What is the current market condition?
Yes, so that's two questions. So I'll address PRMG first. We are special in the effect that being a direct lender, we're at the top of the food chain, if you will, for getting loans through underwriting. And so there's a huge disparity in lenders because of the way the underwriting is done. So depending on your underwriting flexibility and how you actually portfolio your loan is going to determine the ability to get around a lot of the conditions that may come up on a file. So for example, we're direct lenders to Fannie Mae, Freddie Mac, and Ginnie Mae. So what that means is that we can do anything that those guidelines would allow. Versus if you're not direct to them and you can't take your file directly to them and say, hey, I'd like to do this, can I get an exception? Are we allowed to do this through the entities? Then you have basically portfolio restrictions as a lender. And 90% of the banks have portfolio restrictions because they're not direct to Fannie Mae. So ultimately, if you're not a direct lender, then you're subject to the guidelines that the bank has put out, or the broker, whatever broker you're working with. And that broker is not going to be able to get past any conditions that are outside of that portfolio restriction. We don't have that issue. And so therefore we can do whatever the entities allow.
Very good. So having that connection is very important because you know what their guidelines are and what they are willing to make an exception to and what they are not.
It's the golden goose in lending is being a direct lender.
Yes, yes, and because of that direct connection, also that means that the file is expedited, correct? Because
That's
I
correct.
mean, you could pick up the phone or send an email and get that particular issue resolved.
Yes, that's correct. The loan officer has more access to being able to mitigate the file. And then myself personally, being the #1 producer for PRMG in South Florida, we have direct underwriting capability. So we have our own 4 underwriters that underwrite every file I have. So it's just the next step to allow more efficiency for the amount of files that we do.
Very good. That's definitely an advantage, and that should be a strong consideration why clients, people needing mortgages, especially first-time buyers, should consider working with PRMG because of uh, that direct connection and the fact that they have your own underwriting process in-house. Makes it so much faster and much more efficient in terms of the communication. Oftentimes, when we're working with a particular lending institution, it takes days before they actually respond to you because they are so busy. I think that one of your differentiating factors is that you have that personalized touch as well, correct?
That's exactly right. That would be accurate.
Good, good. So before we get into the current market conditions, earlier we talked a little bit, or you mentioned a little bit about the importance of having a good credit rating for all people, for all borrowers, really, but especially for people who are, buying their first home. If somebody doesn't have the 700 credit rating, what kinds of things do you recommend to remedy that situation for them to improve on their existing current rating? Is that something that you guys get involved in terms of counseling people, or are there other independent advisors that actually work with individuals who need to correct issues in their credit?
Yeah, so we obviously can give great advice to any client that's looking to improve their credit score. And then we would refer them to a credit agency or repair agency so that they can go ahead and do the necessary things if there's further repair needed. The first steps are really discussing the amount of revolving debt that a customer has and explaining to them how utilization affects their credit score. So if they can get those bills paid down and those revolving debts paid down to under 25% to 20% of their total available limit, they're going to see an increase in credit score very rapidly within a 30 to 45-day period. If they have significant charge-offs or other issues that are underlying their score, then they would be referred to a credit specialist that would work on attempting to improve their score by disputing old items and or helping them negotiate those items to be paid so that credit score can slowly over 3 to 6 months improve.
Right. So what I found out also with clients is that many of them will have a number of revolving lines of credits that are available anywhere from, let's say, a Macy's account to, a bank account. And oftentimes they don't use them, like American Express. Some people pay their bills immediately. What is your recommendation? Because when you do the underwriting, don't you take a look at all that the credit that they have available? So let's say if they have 3 separate accounts and each of the accounts is up to 30,000, that means that they will have technically up to $90,000, right? That they get into debt. Do you recommend them, closing some of those accounts, or will that help having so many revolving lines of credit open?
So lenders don't worry about the amount of utilization that's not being used. So that would mean that we would never encourage, or the underwriter would never suggest that someone lower their credit availability to qualify for a mortgage. we use a debt ratio calculation, taking the minimum payments of all of the debts on the credit report and calculating that against the gross income of the borrower. So we would never encourage them to lower their utilization.
Correct. So that will be then the total debt to equity ratio. Could you elaborate a little bit more on that so that people who may not be familiar with it, they could pay closer attention so that when they actually apply, they will be under, a certain limit, let's say 25. Is that 25 to 30% that you guys look at, or what is the magic number?
Right. So there's two different things we're speaking about. One is credit score. In order to improve your credit score, you'd want to lower your utilization of your revolving credit cards. If your score is already good, then you don't have to worry about your utilization. The second part of your question is the debt ratio. Debt ratio has nothing to do with your utilization. So if your credit score is 720, your utilization has nothing to do with actually improving. So the second part of that would be your debt ratio. So if you have 3 credit cards and you owe a total of 60,000, and your total payments on that 60,000 is 900 a month, and that may be including a car and maybe a couple credit cards, and it's 900, we're just going to take that $900 minimum payment or that installment loan, that payment that you make to the bank or the lender, and we're going to use that against your gross income. So if you make $3,000 a month, we would take the $3,000 a month as your gross income, and you would be hit for the $900 that's on your credit report as your minimum payments. That plus your current proposed housing payment, the new payment you're going to be getting when you buy a home, would be then calculated and added together to come up with your debt ratio. Your debt ratio cannot be exceeding 50% for a conventional loan, and typically around 56% for an FHA loan. So if you make $3,000 a month, then you would know as a conventional loan that your maximum amount of debt that you can have, including the new mortgage payment, with all the revolving debt minimum payments, as well as credit cards, couldn't exceed $1,500.
Correct. Very good. I think that's very helpful to our listeners who are trying to determine how best to qualify or actually what to do if they are in a situation where that doesn't meet those particular requirements. What about points? How does pricing takes into consideration? Does that have to do with the overall credit number, the credit rating, or how do you usually price and what makes you different?
So pricing in terms of what interest rate a borrower can capture, there are many factors involved in that. And that comes down to your credit score, it comes down to the amount you're putting down, and it comes down to other factors involved with if you have an FHA loan versus conventional, the pricing is definitely different. So every person's different, and there's no real way to say, hey, this person's going to get X and the other person's going to get Y, because there's so many different ways to do a loan and to structure the loan for the customer.
Right, absolutely. It is very, very individualized. Each particular transaction has their unique, characteristics.
Points are usually paid, by the way, if in fact you have a borrower who may have a weaker credit score and they want a better interest rate. Sometimes it's better to pay that extra point. 1 point would be equivalent to 1% of their loan amount. So on a $300,000 loan, if someone wants to pay 1 point and their credit's not so good, mid score of 600s, then they can get that rate down sometimes significantly, maybe even a half a point or more. So then it would be beneficial for them to consider paying the points if they had the extra cash after the closing costs and down payment.
Yeah, it makes sense. When in the example that you gave us earlier, where there was, the $900 total debt, and then to that you add whatever the monthly mortgage is going to be. That's going to be one of the factors to consider against your $3,000 a month income that you have. That income, is that gross income or net income?
That's gross.
That's
In that
gross
case,
income.
the customer would never qualify, so you'd have to have a person making more income. So you could use an example of like 5,000 a month to that example. 5,000 a month, and then 900 in debt, and then let's say maybe an $1,800 payment, or you got to be under 50% to go conventional. So that's where we do the calculation.
Okay. And what about situations like we're currently working with a particular transaction where the borrower is actually not the primary resident of when they're buying the home, but they are having the existing seller obtain a lease. So the seller is basically selling their home, but they are remaining in the house and paying a monthly rent to the current buyer. Is that considered? How is that viewed by the lender?
If the seller wants to rent back the property after they purchase, it has no effect on the buyer.
Right.
The buyer would still purchase as a primary. They have 60 days to move in.
Yeah. It has no effect on the buyer. However, the buyer is receiving additional income. So I guess that's considered part of the overall gross.
They wouldn't utilize that income. They would just indicate that the buyer has 60 days to move in to be considered a primary residence. So a typical rent back couldn't go past 60 days.
Okay. All right. So remind me again how you're different from other lenders. We were talking about the specialization, the specialized service that you're providing, but you also provided the services, correct? Do you also provide like title services to your clients?
So we offer title. We have a partnership with a title company that I don't personally partner with, but we have a partnership that we have. So we actually, do refer our title out. It's always good to be in control and have a company you trust and know to doing title. So we always refer title to a customer here in Broward County. A lot of times the realtor mostly does refer the title company over, since we do a predominant amount of our business comes from referrals from realtors. Usually the agent likes to select the title company.
Right. Okay. So tell us a little bit about how you're different from other mortgage companies as you work with real estate brokers, as an example.
Yeah, because of the dedicated underwriting and being direct to the agencies, that allows us to underwrite files about a third of the way before we find a property for a buyer. So we can start the underwriting process before the buyer finds a home. And that's how we can utilize the underwriting process to our advantage, because now we have a customer who's a third of the way done through the transaction before they find a home. 95% of lenders don't even consider underwriting a file without a signed contract, an application from the buyer, and they won't go into underwriting until they've ordered an appraisal. At that point, the buyer is typically into the transaction for around $1,000 with inspection and appraisal. With us, we can actually be assured with our underwriting, we will actually review the file, do a full income analysis before the buyer finds a home. And that way we have a more assured buyer, more peace of mind for that buyer, and we can close quicker and offer better terms to the listing agent when making an offer. All that equates to our buyers have a typical advantage in the market over most buyers in the market.
And in that process, do you provide like a pre-qualification letter, not a commitment letter, but a pre-qualification letter, so that when the buyer actually goes to make an offer, they could tell the seller, look, I've already been pre-qualified, versus somebody else who has not, who may or may not be capable of financially purchasing that home?
So most people have to present some sort of letter to a seller or a listing agent when purchasing and making an offer. Where we differentiate ourselves is we have to communicate with the listing agent, what I had just explained, about how we can actually approve the buyer through underwriting. We send them an underwriting approval through our desktop system, and then we will go ahead and actually show them conditions in some cases and explain to the seller that we have conditions on the file already. So we've already started the file. So we give them an automated underwriting report, and then we can follow it up with a phone call and discuss conditions in a lot of the cases to help win the buyer's deal.
That is extremely helpful because the buyer, has been, I mean, the process is much faster. And certainly as the seller wants to know that A, he's getting a competitive price, and B, that the buyer is able to afford it, right? That he's actually going to be able to go to the closing table and all is going to be satisfactory. So that's excellent, Michael. Thank you for all the clarifications that you have made. Very, very helpful to our listeners. And then just a quick personal question before we close, and that is, if you have not chosen to be a lender, and the number one lender for that matter in your area, what are the careers you have chosen and why?
Well, I originally in 2002 was training to be a financial advisor with UBS. And at that time, I had made a decision after taking the training courses that wasn't the right path for me. And I somehow got into the mortgage industry, which I felt was more flexible and more self-autonomous versus less corporate. And so that kind of worked out in my early 30s when I decided to get serious about my career. So was financial advising would have been probably too of a stiffer type of thing for someone like myself. So I wanted more autonomy and independence, and the mortgage business has provided that.
No, absolutely, and they're still financially related. So, so that was sounds like it was a really good, insightful move for you as well, because in the financial advisory in the securities area is highly legalized, and all these rules and regulations. That, not to say that the mortgage lending doesn't have them, they do, but they tend to be a little more flexible. So I absolutely understand it. Having had a background in banking, I certainly can relate to what you are saying in terms of, it's fun dealing with people and helping people achieve their dreams, like in your case, providing them with the financing to be able to buy their own home. So I thank you for your time with me. And in closing, I would like to thank you for tuning into the Financial Legacy Podcast here with me, Maria Ellis. To learn more about how to work with me, go to financiallegacy.live. Here on the Financial Legacy Podcast, we are changing lives one person at a time. To help you create and enjoy your financial success, connect with us at financiallegacy.live for your complimentary consultation. Thank you again, Michael. Be well.
Thank you so much, Maria. Have a blessed day.
Thank you.
Bye-bye.
Bye.
In providing answers, neither Maria Ellis nor the Financial Legacy Podcast and guest speakers are acting as certified financial planners, advisors, certified financial analysts, CPAs, economists, accountants, or lawyers. Neither Maria Ellis or the Financial Legacy Podcast and guest speakers make any recommendations as to any specific securities or investments. All content is for informational and general purposes only and does not constitute as financial or legal advice. You should consult your own tax, legal, and financial advisors regarding your particular situation. Neither Maria Ellis nor Financial Legacy Podcast and guest speakers accept any responsibility for any loss that may arise from accessing or reliance from any information in this podcast. And to the extent permitted by law, we exclude all liabilities for any loss or damages derived directly or indirectly arising from the use of the information.